August Biniaz with Real Estate Investing Demystified. We're here in Las Vegas at the Multifamily Wealth Project Conference, and we have author, thought leader, scholar, Brian Burke, hands-off investor, and Ava, our CEO, is on my case. I had to get an interview in, so really appreciate you taking the time. Brian, tell us a little bit about what brings you to the conference, and talk to us about the real estate market, really on the macro level of what's happening with the market.
Well, there's nothing more interesting to talk about than multifamily real estate. And considering I don't know anything else, I might as well come here and talk about multifamily real estate. And there's a lot going on in the market right now. Obviously, we've seen major changes in the interest rate environment. We've seen changes in costs like insurance and other expenses that are going up. And at the same time that's happening, rent growth is going down. And a year ago, it wasn't uncommon to see 20% rent growth in a market. And we're not seeing that at all right now. And I think people needed to get a reality check on where the opportunities really are, and when to look for opportunities, and maybe when to just sit on the sidelines for a little bit.
Talking about sitting on the sideline, there's a lot of newer syndicators, newer sponsors, people getting into the space who in the past might have been LPs, are seeing the type of money they made over the last 10 years. Now they're coming into the space as general partners. What is your advice to them in the current market? Is it to sit on the sideline? Is it wait? And kind of thing I always say is wait till we're no longer in an increasing interest rate environment, and then maybe try to come in. What is the advice there?
Well, you can actually make money in an increasing interest rate environment. What the biggest problem we have right now is nobody really knows what's happening. If you have some sense of certainty where the market is going, you can adjust for it. You can say, okay, we know interest rates are going to be here, therefore I can only pay this amount of money for this property and still make a profit. The problem is nobody really knows where interest rates are going, and sellers are going like, oh, next year rates are going to tank. And if they don't, so they still want a high price, right? Buyers are thinking, well, interest rates are going to go up. So now you've got this, this dislocation where nobody can get a deal done because their perspectives are so different. So it really is more about not so much what's happening, but having an understanding of what's happening. And for the last year, there's been no understanding. You don't know where rates are going. You don't know where expenses are going. You don't know where exit cap rates are going. You don't know where rent growth is going. But all of those things will start to bubble to the surface as months tick on, and you'll get a better sense of where those indicators are going. And that will at least allow you to underwrite with some level of confidence. And if you can find sellers that will transact at that price, you can do really well.
Of course, talking about underwriting with a level of confidence, what is your recommendation when it comes to debt? Should it be fixed rate, long-term debt? Should it be bridge, which is the tool that syndicators have used all the time because it allows for that cash flow right off the bat? What is advice there?
Neither.
Okay.
I've strongly preferred and always have and probably always will floating rate agency debt. Okay. And the reason that I lean towards that, one, I don't really like bridge at all. Bridge has a really specific purpose, and that's for a really deep value add that won't qualify for agency financing. You have no other choice but to get bridge. Okay, I can understand that, but it's really challenging when you have a 3-year maturity. That'll come in a second. And if the market isn't going your way, you're going to have no exit. You'll have no refi to take out. You'll be in a lot of trouble, and there's a lot of syndicators are in a lot of trouble for that very reason. Agency fixed is a problem because if interest rates do go down, those yield maintenance penalties will get extreme. And now you've locked in maybe what is the top of their interest rate curve, and now you've got extreme yield maintenance, and that can be really problematic. I like agency floating rate debt because if the rates go down, the rates go down. Now the risk is if the rates go up, you've got that. And so
can you buy a rate cap for that?
You should buy a rate cap, and they'll probably make you buy a rate cap. So you absolutely should have a rate cap.
Got it. Let's talk about investor sentiment. You wrote the book on it pretty much as far as passive investing. What are you seeing out there? You haven't done a deal for a while, and that's been strategic. You haven't done a deal. Do you still communicate with your investors? Are you seeing that? You have your finger on the pulse of the industry. Obviously, we've talked to a lot of sponsors here. Is the equity markets are extremely tight. What are you seeing in the market? Even though you haven't reached out to your investors for any equity in recent times, but what are you seeing?
Actually, we've been raising money, but we haven't been raising money for real estate acquisitions.
Okay.
So we've been raising money for a debt fund. We've been buying real estate debt. To me, it's a much less risk place to be right now. It's immediate cash flow. And it's just a whole different element, whole different spectrum of the risk curve, and that's where I want to be right now. And so our investors are taking to that really, really well. That's at least giving them a place to invest while we wait for the market to correct itself. And when it does, then we'll be going right back to real estate. We're still underwriting deals continuously, so we're staying in touch with what's going on in the market. And when the time is right, we'll be able to pull the trigger, and our investors will be there for us.
Amazing. Yeah, it's like basically a debt fund is they get a set flat rate. They don't participate in any type of upside, but it's basically what you charge your clients when you lend the money out, and your investors receive a portion of that. Basically,
right. There's no upside in debt. You can't tell the borrower, "Hey, you borrowed $1 million from us, but now you owe us $1 million too."
Yes,
Right.
That's right. That's right. Last part here is about a region, and the majority of your presentation was about the regions. That's what you're saying: the good and the bad and the ugly. What is your predictions when it comes to the region? You're well diversified in multiple regions. You were talking about that on stage. What is your predictions when it comes to the region? There was a particular attention on Florida. We saw all those green boxes in Florida. We're moving to Florida, our headquarters. Give us your predictions when it comes to not only your predictions, but what you're seeing in the market, and what is your advice when it comes to great markets to invest in?
So what I'm seeing right now is I'm seeing the Midwestern markets actually for the first time in a long time. We're seeing some rent growth that's above the national average. So that's unique. I don't think it's going to last. I'm seeing Florida getting a little bit of a hit from where it was, obviously, but still leading the nation. They probably are more cities on the top rent growth list in Florida than any other state.
You had to create a second slide just because that first slide was mostly all Florida.
That's right. I had to create another slide just to have other top markets that weren't Florida. So Florida is definitely a great place. People are flocking to low-cost, low-tax states with less bureaucratic red tape, more business-friendly places. People are going there and they're investing there. And I think Florida is a benefactor of that.
Awesome. Hey, man, really appreciate your time. Let our viewers know how they can connect with you, possibly invest in your debt fund. When you come back into the multifamily space, you've been hitting royal flushing on every one of your investments. So possibly when you come back to this space, well, yeah, let our viewers know how they can connect with you.
Yeah, the best way is through our website, praxcap.com. It's praxcap.com. You can also follow me on Instagram at Investor Brian Burke, or catch me on Bigger Pockets in the forums answering questions.
Awesome. It'll be in the show notes as well.
All right, man.
Thanks, man.
Good to
really
see
appreciate
you,
it. Absolutely.
All right. Thank you.